Welcome to How to Attract New Investment Assets. Matt, talk about this little picture right here, because this is when I first talked about this with you. This is the concept you told me you can get people to do with you. What is this concept?
Okay, so the concept is that we want our prospects to open their minds to the idea that we're here to teach and help them understand what it would be like to have an actual methodology to how they deal with their investments and financial planning. Okay, instead of it being a situation where they're trying to decide whether or not they should work with me, what we really want them to do is figure out whether or not they should use this methodology. Okay, so really just opening their mind to, if I can pick the methodology first, okay, and then now I realize that my current advisor, or if I'm doing it myself, I don't have the ability to implement this methodology. Now I have to go find someone to help do that, and by the way, that would be us. So what we want to do here is make sure I don't want to go in and combat the existing relationship or the do-it-yourself person up here. I want to help them understand that there's some benefits to having an actual methodology, help them understand they probably don't have a methodology, or the one they have right now is not as good as this could be. And then once they've been led to that decision point, now they have to figure out how and who they're going to use to implement that methodology.
And since this methodology pretty much only exists with Matt, because he made it up, then they're going to go with Matt.
That helps.
Here's the reality. Look at that picture. You see that thing? This chapter is going to show you how to get them to turn over their entire nest egg to you. That's what it's going to show you. Some of you are only in the risk-based side right now. All you're doing is selling insurance. And we're going to cover that in the next session. But don't miss this. And let's talk about this whole survive long enough to thrive. Let's talk to the new reps for a second.
Yeah,
And by the way, before he says this, new reps are thinking right now, Matt, you've been doing this for 20 years. You got all these portfolios of people. I'm just trying to survive here and sell insurance. Why would I even want to listen to this chapter?
Yeah, so the background for me is I only did sell insurance for the first 5 years, okay? And so the sharing on this is don't make the same mistake I did. I do believe that insurance pays me today, investments pay me tomorrow. And this idea of surviving long enough to thrive comes from the idea that if I overly get excited or overly focus on trying to bring in investment assets in the early years and ignore the risk-based side, because of the way we're compensated, I may not be around long enough to actually get all the cool benefits that come from bringing in the assets. But on the other extreme, if I'm only focused on risk-based, especially to the point where I'm really not talking about planning and positioning myself as a planner to my insurance clients, then I'm delaying and putting off all the great benefits that come from all the residual revenue that can be really cool that comes from the investment side of things.
And here are those benefits. Matt, can you talk about this? This is the number of years Matt's been in the business.
Right.
And
So
he's saying don't make the same mistake as he did. Take a look at this.
Yeah, so I think this chart, when Jason and I put this together, was let's start in year one. How much of my income came from investments and how much came from insurance sales? And it probably should have been 100-0 because there really wasn't anything at all from anything investment related. Year 10, which is a long time, by the way, and this is where I think the mistake can be improved from what I did, 30-70, okay? That really only represents 5 years of focusing on investments, though. So my encouragement to somebody who's in the early stages of the career here is if you can start paying attention to the investments right out of the gate, this kind of a split ratio-wise should say year 5, not year 10.
That's big. Change that.
Does that make sense?
And you can see this on page 170. Change that. Put a little star next to the 10 and cross that 10 out and put a 5 in that chart on page 170, because that's really where you want to be.
Or maybe think of it slightly differently. Wherever you are in your career, you could have been doing this for 10 years right now, and if you haven't paid attention to investments yet, you're year 15. So 5 years from today, that's where this should go if you're really paying attention to the investment side of things.
Mm-hmm. Good, and the other chart we want to show you is this. This is a $10 million hypothetical example. I think a lot of people know this, Matt, but some people don't really see the numbers the way you've drawn them up. And this is a chart you actually made. Can you talk a little bit about how this helps the new reps thinking about this whole investment side of things?
Yeah, there's a lot of numbers on here, and everyone's different as far as payouts and stuff, but what this is showing is on your far left, someone bringing in $5 million. So whenever you decide to turn this thing on, so it doesn't matter how many years in the business you are again, but I'm going to start paying attention to investments right off the bat. And one really important part of this is you have to have a goal around investments. In my opinion, your goal should be based on assets under management. You're bringing in new assets. It doesn't matter to me what kind of, it's a front load or it's a residual, all that stuff right now. It's all about paying attention, okay? If I put a goal up there, I'm going to bring $5 million in this year. When you're in front of a prospect and a fact finder, your eyes will start to go to where's the money. If you don't have a goal on assets, your eyes will not go to that, and you'll miss huge opportunities. At least I did. So on the far left, it's $5 million a year coming in for 5 years, and then after that, you finally figure it out. Now you're doing $10 million a year. These numbers, in my opinion, $5 million right off the bat, I think is pretty decent, but much sooner than 5 years, you should be at $10 million. And anyways, my point is, it's not a rocket. It's not a rock star. It's just a pretty decent course. Okay, so average producer on the left, rate of return, just so you have some kind of growth rate on the assets, is in the second column. There's your assets right here. But getting to the fun stuff here, the fees generated in total, and then the fees are coming to me, the advisor. So in year one, I had a whole $18,000 of revenue coming in that year, which isn't horrible, but it certainly isn't anything that's going to rock your world. All right. But in that second year, that number jumps to 43, then it's 66, and jumping down here to year 5, we've got 145,000, and this is residual recurring revenue.
We're going to show you 3 ways to attract new investment assets. And the first one is on the screen there. Open their minds to a new financial methodology. This is step 1 for any rep in the business from 1 to 30 on years up. First step is to open their mind not to you, to a methodology. And this is where most reps drop the ball, because they're trying to get people to come to them. And they can't start with that, because that'll put them on the what?
Defensive.
Yeah. Step 2, help them determine the best methodology for them. And then, of course, the third step is, well, let me help you find an advisor to adopt that methodology. And it just so happens, since this is brand new, and you guys probably never even seen this methodology, that guess who's the only advisor who can do this? You. We're going to start with how to open the prospect's mind to a new financial methodology. Underline this, first sentence on page 172, most people do not have a financial methodology. Clients typically think they have one, or they assume their financial advisor has one. Now listen to this, underline this one. In reality, they often don't, and most of the time, neither does the advisor. Before we even start this, there is an absolute must prerequisite, and it's in the box, in the stop sign box. You've got to get the prospect to open his mind. Matt, let's have a seat and do this together.
Sure. So Jason, one of the opportunities that you have in working with us through this process here as we get into the investment side of things is to really be open to learning about a new methodology or a different methodology to maybe what you've been used to. I'm not saying this methodology is better or worse. What I want you to think about as we're going through this is to leave aside for a second who is responsible for handling this methodology, but just to figure out for yourself, is this a methodology that would help me get to where I'm trying to go moving forward? So in other words, what you've done so far to get you to where you are right now is fantastic, and we're not trying to judge that being good or bad. The real question, though, as you start to evaluate this is, moving forward, is this the right methodology to help me accomplish my dreams effectively?
So Matt, what is it about your methodology that's going to be different here? And it's all about the life plan versus the what?
Well, the investment plan. So
Yeah.
the one thing that you should say right around here somewhere, what we like to say that works well is, Mr. and Mrs. Prospect, one of the things that we've observed over time is that unfortunately most people's investment plans are driving their life plan. Okay? What I mean by that is, as crazy as it might sound to you, is, gee, markets are doing really well, I feel very good about going on vacation. For some reason the markets aren't doing so well, suddenly I don't go on vacation. Okay? It can take the form in a lot of different forms, but the reality is that's an example of your investment results or your investment plan driving your life plan. We feel strongly that your life plan should be the only thing that drives your investment plan. And what we have to help our clients, their prospects, think about here is that the things that we help our clients save and plan for never have a finish line. Okay? There's never a day where they say, okay, I'm retired, I need all the money today. We're going to have a great retirement party, and then the money's going to be gone, right? So if I've got my $3 million, it doesn't all get spent on the first day of retirement. But there's going to be segments of the pie that we're going to use over a long period of time. So in year 1, I'm going to use part of my pie. In year 2, I'm going to use another part of my pie. But there's a part of the whole pie, even at 65 when I retire, that I will not use until I'm 90, if I can make it that long, right?
This is called, on the bottom of 176 of the stop sign, time-weighted asset allocation. Probably the most critical concept in this entire chapter. And it's this: the process of connecting math to the dreams. And you might say, well, that sounds like a lot of theoretical fluff. What does that really mean? Well, we'll tell you about it in a second. We're going to tell you exactly what it means in a second. But before we do, Matt, can you talk about page 177, the two extremes, the bear and the inflation, what most people try to avoid?
Right. This is how we explain. So this is how I explain why go through the hassle of trying to figure out when I'm going to use the money. Who cares? right? Well, here's why it matters, because there's two extreme risks that we have to be aware of or cognizant of when it comes to managing your wealth, all right? The one is the surprise bear market, okay? And is there really any kind of bear market than the surprise one? There's always a surprise bear market. No one ever sees them coming. So what I mean by that is if Jason and I are here talking today and we have a plan, a big goal, life goal here that we want to buy a cup of coffee at Starbucks next week. That's my only goal. That's my objective. If I can accomplish that objective, life is great, okay? And we've got a $5 bill right here on the table right now. The best investment strategy for me to accomplish that goal for next week is to put that $5 bill in my pocket, and I will accomplish my goal. Next week, the cup of coffee will be $5. I'll have my $5. I will accomplish the goal. For me to try to get cute with this $5 and invest it in some kind of a strategy over the next 7 days that could make me $6 or it could take me down to $4 makes no sense, right? Because the only thing that could screw up my plan is if I try to get cute with this investment, it drops to $4, next week rolls around, I want to buy my cup of coffee, and I can't accomplish my goal. So the idea here is that for shorter term goals, the only thing that can really screw up the plan is a bear market, forcing me in a situation where I have to sell something at a loss. The best antidote or medicine for that risk, we all know, is cash, or something that can't go backwards.
And what about the opposite extreme?
Well, so the opposite extreme would be, look, if I'm going to buy that same cup of coffee, but we're not going to buy it for 15 years, okay, that's the goal now, and I have my $5 bill right here, I know for a fact the investment strategy that will not allow me to achieve that goal is my pocket. I can't put $5 under a mattress and then in 15 years from now buy that cup of coffee, because how much will that cup of coffee cost in 15 years? $6, $7, $8, $9, $10, more than $5, right? Why is that? Inflation. Things always cost more money later on. So if I have a $5 bill that I'm trying to put away for a goal 15 years from now, okay, the risk of a bear market happening today is irrelevant. Every bear market makes its way out and back, and then some way, way, way ahead of 15 years, usually 3 or 4 years, much less 15, okay? So that's not a concern, but there still is risk, and the risk is that things will cost a lot more money in 15 years, which is inflation. Now, to fight that risk, the antidote is part ownership in great companies all over the world. That's the best strategy to fight that particular risk, which is equities. So the concept here that we're all kind of born with, I think, in our heads, just maybe don't articulate it very well, is match up the antidote with the risk we're trying to deal with. Long-term risk is equities, which is inflation risk, and short-term is bear markets, which is cash. All right, so we just went through and explained the obvious, as Jason was saying before. Short-term risk is bear markets you can't recover from in time. Long-term risk is inflation, which is, of course, they've all heard these things before. So all we're going to do is take those two concepts and make it something a little more specific, a little more articulate, okay? We're going to blend it together. Because the reality is, if I'm 65 years old or if I'm 25 years old, do both of those people still have inflation risk as a part of their lives? Right? Do both of those have bear market risk as a part of their lives? Yes. So all of the traditional methodologies tend to be based on people's age. Okay? As you get closer to this, take your age minus 100, and that's what you should have in bonds. Or you should, you're 5 years from retirement, you should be more in bonds or whatever. Maybe that's the case, but the reality is you have to look a little bit deeper. Let's understand what's the true time horizon for the segments of your dollars. And if we can allocate it across these different segments, you can make incremental decisions on each of those 4 time horizons that you're comfortable with. And most people can make very good incremental bite-sized decisions, but it becomes very difficult to make non-emotional decisions when it comes to making on the whole pie.
So Matt, I'm going to switch places with you. I'm going to be the prospect. And you guys can watch as we role play these 3 stages with the 4 client asset time horizons.
Now the good news is I'm not an artist, and I could have this all pre-printed and stuff, but I always draw it out in front of clients. It seems to have a bigger impact that way. So as we get into this, Jason, we'll go. So Jason, what we talked about now is this concept between understanding the bear market risk is the big deal in the early years, later years is inflation risk. So all we're going to do with time-weighted planning is to start to connect the dots, okay? So all we're going to do now is have 4 time horizons, 0 to 3, 4 to 8, 9 to 14, and 15 plus. And all I want to figure out is up here is all your wealth. Here's what you've gotten so far, what you have today. And along with that is here's all the goals we've already talked about. Here's how you want to live. Here's when you're going to start using your money. We're going to take all those goals and compartmentalize your wealth into when you're going to use your money. So you said before that you want to retire next year, Jason. So that means you want to spend about $100,000 a year to be okay. Well, just simplistically, that means that you're going to need about $200,000 in this 0 to 3 year bucket, because you're not going to need any of your wealth next year. You're still working, but then the next 2 years after that, you're going to need to have $100,000 a year to do your thing, right? So simplistically, your $2 million pot of money up here, we're going to put 200,000 of it down here.
Okay.
All right. And the rest of this, as we go, it gets a little more complicated, but then we're also going to figure out how much of your money you're going to use for you and your wife in years 4 to 8, 9 to 14, and then the rest will be sometime beyond 15 years. Now, why we want to go through the hassle with all this, Jason, is pretty simple. If I know for a fact that you and your wife have some money here, you and Jess have money that you know you're going to want to use in these next 3 years, our opinion is that money should be allocated to cash, okay? I know cash isn't paying anything right now, and it's not a good long-term place to put money because it gets killed by inflation. But if the money's only going to sit there for a couple of years, inflation really doesn't matter. What could matter, though, is if this bear market happens or something just unforeseen occurs along the way, and we're forced in a situation where we have to sell something at a loss for you to reach your goal. In my opinion, that's a fireable offense. Unacceptable, fail. Any of our clients, we tell them this all the time, if we ever have to sell something at a loss, we should be fired. And it's not because my team or I have any ability to look in the Ouija board or the crystal ball and see what's coming down the pike here. In fact, we believe we can't, and neither can anybody else. The reason we don't have to worry about those, we're going to be smart about our communication, so we know when you're going to use the money, and we're not going to get greedy.
Okay.
All right? Now, some of our clients will say, I only want 2 years of my money in cash. Some will say 4, but most people land on 3. We'll talk about that. You'll have input on this thing right here.
Okay.
Now let's flip all the way out to the other side. On the 15 plus your money, okay, whatever portion of your net worth lands there, our risk here now is no longer bear markets. We talked about that earlier. It's what?
It's inflation.
Inflation. Things get more expensive. And what's the best way to fight inflation? Equities. Part ownership in great companies around the world. So out here, we're going to allocate that portion of your wealth, 90% equities and 10% fixed.
And that makes sense, because if there's a bear market, it'll come back.
Exactly. Yeah, so what'll happen, like if we go back to 2008 for a second here, Jason, okay, what's really unique about this strategy is that in 2008, our retired clients would come in at the very bottom there, and their whole pie was down about 27%.
Okay.
Now think about this. You're not retired today, but think of this. You're retired, there's no income coming in, you're relying on your nest egg, and you have whatever you had down 27%. So as you might imagine, some pretty interesting conversations.
Yeah,
with our
that's a big
clients.
deal.
It's a big deal. But what we had been able to do with our clients, there's two benefits to doing this. There's a mathematical benefit and an emotional benefit.
Okay.
Here's the emotional benefit. When our clients came in for that, because they already were aware of the time-weighted planning, we broke their pie back into the 4 pieces, and we're able to point out that, you know what, Jason, Jess, your 0 to 3 year money hasn't gone anywhere.
It's fine.
It's cash. So you still have another 2 years left of runway that you can live off of without ever having to sell anything at a loss.
Okay.
All right? If you look at your 4 to 8 year money, that's typically 40% equity and 60% cash. At that time, that was down about 5%. So still not great, but not so scary.
Well, it's a lot better than the 27.
Right. Now, to be fair, your 15 year money, Mr. Retirement, client at that point in time, wasn't down 27. It was down about 38, which is really scary, except for the fact that we can start asking the question now, not will the market come back tomorrow or next week, next month, or even next year? Because at that point, it sure didn't feel like it was going to.
No, in 2008, I didn't think it was.
The question, though, really was, since it's 15 or more year money, do we think at least one time in the next 15 years something better will happen in equities? At least one time, 15 years. Well, yeah, everybody's like, well, yeah, 15 years, of course something good will happen. Well, if that's the case, then not only do we not have to panic or worry or do something bad, like sell at the wrong time, we actually should do what?
We actually want to probably buy.
Right, exactly. And when we do that...
Can I just stop for a second?
Yeah.
Did you see how he got me to say it? And also, but I'm exhaling now. I said earlier, I'm going to exhale during this presentation. I'm feeling so much better about my finances right now because of this guy than I did with my old advisor, because of these 4 things. Keep going. Sorry about interrupting, but
great.
I wanted to say that.
And that's important. I do want him to answer the question at that point. So now we want to buy. And if we can do that, okay, if we do that at that point, now we're in a situation where we actually recover faster than before, okay?
What do you mean we recover faster?
Well, so here's what I mean. So if we are in a situation where this is our starting point and the market starts to drop here, and we buy a little bit more right here, whenever the market comes back it comes back faster. So if I go down
I
here,
see.
okay, and I don't do anything, I just ride it out and I come back here, that's fine. But if I buy a little more here, I get steeper as it continues down. If I can draw that.
Because we're buying low.
Right, and now I
Yeah.
get back to break even sooner.
Okay,
So
yeah.
before we get to that, so there's so one thing here, Jason, is emotionally we're able to make sure that people aren't panicking
Yeah.
and doing the wrong thing. Secondly, then mathematically, we can actually responsibly take advantage of what the market is doing. When we make that buy decision, it's not because we think it's the bottom. If that were to happen, it'd be purely coincidence, Jason. But we are buying at a relative low
Yeah.
to get us back to our target allocation. All right, so staying with this for a second here, the idea then is to make sure that we have everything allocated like this. Now,
So that's 70-30 there?
70-30 here. Now, along the way, if our clients say, look, 90% equity seems really aggressive for me, I'm completely fine with you giving us different input on that. But once we set this, we have to agree to stick with it.
Okay.
Just know this, though. We're only going to allocate that aggressive or growth portfolio to your 15 plus your money. It doesn't affect the rest of your portfolio. So this works great for someone who's 65. It works great for someone who's 30. Okay? So quick aside here, if we're talking to a 30-year-old who wants to retire when they're 60, how much of their wealth is in the 15 plus year bucket? What's that? All of it, right? So there's zeros here and then all of it's up there. It's still a good concept to introduce to the 30-year-old because it gives them a path if they're going to work with you or me for their future to say, because once it's here, they know.
Yep.
Here's a question people ask, maybe not at 30, but definitely at 40. When should I start getting a little bit more conservative, a little more stable? Well, instead of trying to pick the perfect day and try to read the tea leaves, okay, we've created a waterfall, right? As you get within 14 years of retirement, part of your wealth will spill down into this bucket. And then part of it will spill down here and so on. So as you hit retirement or whatever your goal is, you're hitting the ground running with a 3-year cash buffer so that even if you retired and then 08 happened the next day, you're still going to be okay. When you put all this together, if I was role playing, if we put all this together, all of our clients have an 8 to 10 year runway between cash and fixed income that they could live off of without ever having to sell an equity.
You're saying that to the prospect?
Absolutely. That's huge because if I don't ever have to sell during the bear markets, I never actually experience a loss. And if I can live my whole life without ever realizing a loss, assuming I had a reasonable amount of money to start with, I'm going to be okay. Doesn't mean we're not going to have unrealized losses. We will. But we'll never realize a loss if we stick with this methodology.
Matt, have you already done that with me? Have you already showed me how to maintain the integrity of the plan?
No, we're going to do it right now.
Let's do it right now.
Right?
So let's role play that one. This is the last one. When we're done role playing this one, we're going to give you an activity where you get to practice this whole thing with the person next to you. But first, let's watch how he does this last piece, which now is all the math. No emotion, right, Matt?
Right. So at this point, I'll jump back into role play. So Jason, what we have to remember here is there's 3 bands. The first band is all emotion, no math. How do you want to live your life? What do you and Jess really care about? What do you want to do? And what's it going to cost to live like that?
Okay.
Second one then is what's the process we use to connect the math, the numbers, your wealth, to that dream? That's time-weighted allocation plan. That just says 4 buckets is this money going to get used in? We did that. Okay. Now the last and final step here is to make sure we have a non-emotional, completely non-emotional system to maintain the integrity of the plan. And that system for us is what's called proactive rebalancing. Okay. Now what that means is after we put everything in and connect all the dots, you're going to have an allocation plan. It might say, based on the weighting, 65% equities and 25% fixed and 10% cash or whatever. Okay. Whatever that is, it is. What proactive rebalancing says then is you're going to have an allocation. So if 65% equities is represented right here, we're going to build in here a don't be greedy line and a don't be afraid line.
Page 181.
Okay, this is 65%. Now this means that if this equities ever get up to 70% of your portfolio or down to 60, that's going to trigger an action on our part. So we know the markets tend to behave like this, but kind of unpredictably, correct? You've seen this before, right?
Yeah.
What happens here is once we get this line, this is the don't be afraid line, that triggers a buy. Okay, things are actually on sale. We're going to buy a little bit more equities back to our target allocation.
Because it's lower.
It's lower, right. Up here, as we're getting hot, we're not going to get greedy, hit our don't be greedy line. We're going to trigger a sell, not all of it, but just enough to get back to our target allocation.
So that's why you call it don't be greedy at the top and don't be afraid at the bottom.
Correct.
Because a lot of people, when it starts to get lower, they get afraid and then they
Emotions take
sell.
over. Right.
When you're saying you're going to do the opposite and buy.
Correct. And now the key here is We're not trying to time it. If it works out, we hit this exactly right and it pops back up, purely coincidence.
So you're not, it's all based on data.
Right. So there's only two beliefs you have to have, Jason, in order for us to feel good about this philosophy. One belief is that an entire asset category or asset class cannot ever go to zero.
When you say asset class, did you mean those 4 classes you shared with me
So what I
earlier?
mean by that, Jason, is it could be the S&P 500,
Oh, I see.
small cap US, international. The whole group of companies cannot literally go to zero. Now, individual companies can, have, and will, and this won't work with individual companies, but with a whole asset class that can't go, that would mean all the people in those companies all walked out and refused to do anything of value that someone else is willing to pay for all at the same time.
And that's
Short of a
never
meteor
happen.
hitting us, which I don't have a plan for, that cannot happen. All right.
Okay.
Now, on the other end, we have the emotion of greed, which is, well, it always goes up. It's a new world. Let's just ride this thing out. That's not a reality either. So what happens then is, even if I'm in a flat market for 10 years, like the lost decade of 2000 and 2010, where if I put my money in and just watched it go up and down and had all the Pepto-Bismol, I didn't get anywhere. With just this approach here, your rate of return now is the shaded area.
That's my rate of return.
Right, even in a flat market during that 10 years. Not because of us trying to outguess the market, because I think that's impossible and foolhardy.
Even in a flat market, I get that rate of return.
Right.
That's
So
pretty cool.
the second thing you have to believe is that those same asset classes that can't go to zero will move up and down unpredictably. If you can believe in those two things, this plan works fantastic.
I'm going to give you 5 minutes to role play with the person next to you. Go.